Hello, this is Coach Mike from winningstockcoach.com. Going to start out with our market overview. It was a weird week in the market this past week. There's no doubt. It actually started with a weird Easter week the week before. It was looking like a nice strong up week, and we basically charged up early in the week, fell down harder than we charged up, and closed red for the week, meaning we closed below the open price. Still to this day, what we've been covering for a few months, that Fibonacci time series leading to the week of March 3rd, still remains our market's, the S&P 500 at least, highest close for our weekly. Even though there have been some higher prices, the closing price for the weekly has remained accurate according to that tool. Now, we've also covered this pink dashed channel since the induction of QE3, which is what we're tapering from, the whole taper thing you talk about, or they talk about on the media with the quantitative easing. And the week before Easter, we actually had that close below that trend line. And since then, Easter week, we shot up above it, and this past week we closed right at it. So how I take that personally is that we really need to see where the market goes come Monday, because using this as a support point, if it were to begin green or moving upwards on Monday, that dashed channel line would be a fairly healthy support for us to use. And when I'm saying that, what I'm meaning is to use it as a point of minimal risk. If it looks like your stocks are going to go up and you see the S&P 500, the SPX, move up from that line, you would be at a minimal risk to take the chance on long entries, so long as you monitored the S&P 500, the value of that channel line, and look to see if it was failing or holding above. If that line fails, you would expect many of the charts out there, especially the positive beta stocks, to fall below the line as well. Now we're going to move this over to the daily chart on the SPX. And we've seen with the daily chart a shift in the trend. Even though I will be the first to admit it's still an upwards trend, it's been a shift in the intensity of that trend. Where we were moving quite abruptly in that ascending pattern before, we've started, and you can see with these darker blue lines, we've started to change the angle at which we were moving. Now, with the exception of, you could say 2 days, but if you look back a couple weeks ago, you made one green day that actually gave you a further low than the red day before it, and you had one strong market day before the market absolutely fell apart. With the exception of that one day, a one-day bounce. I don't call a bounce a one-day bounce. What do I look at as a bounce? Well, look at this multi-day bounce that took place. That's a bounce to me. And with the exception of that one day, as of right now, from our market high actual price, we've made a lower high. Now, if I was going to annotate that on my chart, I would take a trend line, and I would mark that trend line across those two tops. And because it's a downtrend, I like to color code my stuff so I can easily identify it. So I'm going to make that red. And what you would have to look at with this is, for somebody that was short on something, meaning trading for it to go down, you would look at that red line that is descending as your stop out point on your shorts. But you may also have to look at that descending red line as the point which we need to break to not be in a potential downtrend. And that's really, really important to see there, because over the past 18, 19 months, we haven't had a lower high. When the markets bounced in February, after a big pullback in January, even though the S&P 500, the Dow Jones Industrial Average, the Russell 2000 ran on to new market highs, you actually saw some of your biggest stocks, even though they replicated the up move, begin to make lower highs at that point in time. And we're actually going to look at a few of those in addition to our market overview on this market overview video, because I wanted to share how we've been charting some of those in our chat room with the coaches roster to our subscribers and putting out on our watch list, and the accuracy of the trades we've had on them as well. Now, using a few of the tools we've used to accurately predict within 0.1% almost every week for 4 months now that we've been putting out the market overview videos, so long as this red down trend line is not broken above. And I want to also clarify, I'm more of a market neutral. I am not a bull, I'm not a bear. I'm a realist. I look at what a chart's doing and I trade what it's doing, not what I want it to do. I trade what it does. And assuming that we will be in a downtrend until that line is broken above, then I would look at a downside potential target first on the S&P 500 at 1801.97. Thereabouts, within 0.1% or so. And because of the accuracy of the other price predictions we've made and how well it's corresponded to hitting each and every one of those targets, I truly have to trade in relation to what the chart is showing me. We're going to move the chart over now to the DJIA chart, the Dow Jones Industrial. And for the past 7-8 weeks now, we have been talking about these two horizontal lines that represent market consolidation. And what we've really talked about with that is that until the weekly chart closes above or below these two horizontal pink or purple colored lines, however they show up for you, that we can't have a lot of high expectations to either direction, short or long. And the reason is because as soon as you start thinking, oh yeah, this is the time to short, you get a good down week that bounces off that purple line and comes right back with a green week, and we keep trading between these two horizontal lines. What many have done on my suggestion is, even though we're still making trades, we've limited the amount of trades because it limits our risk. We've limited the capital we put into those trades because, in quite honesty, it's a very difficult time for swing trading. Long-term investments, we're still holding long-term investments until the market drops below those consolidation lines, that horizontal channel. And we're seeking a time when it closes above to maybe enter new long-term investments. There's a risk in every trade you make, so we're still willing to take those risks, but we're limiting the damage that risk could do to us while still having the opportunity to profit while within the consolidation channel. Now, looking overall, the longer something consolidates, typically the larger a move will be out of that consolidation. One thing I tell my members all the time is, you're so rarely going to get the absolute lowest buy and the absolute highest sell that it's not really worth the stress of you trying to do it. Trading the market direction and trading to get 80 to 90% of the move in a stock is going to give you more consistent opportunity with less stops and higher profits. So, with that being said, anytime it comes down to this lower line and bounces from it, as it has a few times, is that a good opportunity to go long on a lot of stocks? No. Is it a good opportunity to go long on a couple? Absolutely. You don't want to dump your whole portfolio on a long because it looks like it's going to bounce off of this bottom channel line, when it may only go up to this top channel line and fall, and your stock might not move very much. So we take those opportunities little by little during the time of consolidation, really to protect ourselves. Now we're going to go over to the daily chart on the Dow Jones Industrial Average. A little bit different of a chart pattern, but again, what we are seeing is the lower high, just like we saw on the S&P 500 daily, I'm going to extend that to the right, and I'm going to change that to red because it is a down channel. And just like my explanation on the S&P 500, a lower high that's actually been followed by a lower low, and you can see where my last drop target was. We called that bounce really accurately with that target. We can remove this one, and if we're using our Fibonacci extensions to help us with our next target, we would mark from the high to the low to the high and be looking now for a 15,940, give or take 0.1% or so, as a target area for us to use so long as we do not break above the descending trend line. This is a very helpful and effective approach because we know exactly where the stop would be, and we know exactly what we need to do if it exceeds it. We would stop out of short trades. And as long as that weekly continues to bounce around in these two horizontal consolidation channels, we are left with very little to do but wait. That's a hard thing for a lot of traders to do. And sadly, those traders that it's hard for, I don't know if they just want tax write-offs or if they like losing money, but typically the ones that are losing in times like this are the ones that are waiting for confirmations on a bounce, seeing very small profits, and seeing those very small profits go away as you re-enter the consolidation points. You have a much higher probability of producing winning trades to trade the direction based on the exit of the consolidation channel. And that's what we're doing over with the coaches roster and what we talk about a lot in our chat room each day. And while we are still finding trades and doing well with them, we're doing it cautiously due to our knowledge of how these things work. Next, we're going to look at the Russell 2000. The Russell 2000's the small cap index. We've talked recently about how it's been a bit of a leading indicator to the Dow Jones Industrial and the S&P 500 over, at least the last year to 15 months or so. And we've seen some patterns present themselves on the Russell 2000 that 3 to 4 weeks later have begun to present themselves on the S&P 500 and on the Dow Jones Industrial Average. One thing we are seeing here is after what was still, yes, you'd look at that and say, well, that is a higher low. If we judge by our closing prices, we had a double bottom. And if we judge by the high that was pulled back from, we nearly have, not quite, but nearly have that head and shoulders pattern that we've been talking about for a while. A pattern that's actually shown up on many, many charts over the past couple weeks. As we switch this over to our daily chart, a couple weeks ago we marked that same red channel line. We put another one up here as a just in case, just like we did today with the S&P 500 and the Dow Jones Industrial Average. And we see that though the Russell is a little bit ahead of the game, many of these same chart patterns are being seen 2 to 3, maybe 4 weeks later in the larger indices. As you can see with our small cap index, we've continued to make lower highs and lower lows, and this has been the first time in 18 months that we have done that. The key point to me on the Russell 2000 is this overall low right here. This was the low that was made after the January pullback, right as we got into that first week of February. And should this line be broken, there is no doubt whatsoever, nor should there be to you, that our small cap index will have then officially, without a doubt, made a lower low and done so on any type of chart time frame you could imagine. So that's going to be a key value for us. And I think it's a key value that could actually be tested in the upcoming week. We saw a lot of market weakness this past week. We saw some phenomenal earnings on stocks that have been big name momentum stocks over the past year and a half. And those earnings had an exact opposite effect of what they've had in the past. And that's what we're going to get into talking about next. And I know it's not really the indices that we're going to be talking about with that, but it's very relevant into understanding what some of these things are doing. For starters here, I'm going to go to the chart for Netflix. This is the daily chart over 1 year. I do want to point out and show you the accuracy with, my Fibonacci extension tools and how I use them. I used this tool back in October to predict a high of 457.90. And I traded for this high. Sadly, I was off by 10 cents. 10 cents when it hit $458. The same tool that marked within 10 cents, and I will say I wasn't exact. I don't know who would have exactly picked a number like 458, but if there was one out there, great. I was 10 cents off. But since then, I've been able to use the tool to actually come within 4 cents of this low here, and I have that removed from my chart. But using the longer term aspect, the one that drove me to that 457.90 target, and marking the trading over the same time period, I'm now looking at 205.81 as a potential target area for Netflix. Now, do I think it'll go straight there? Absolutely not. No stock goes straight up or straight down. That is evident in every movement the stock has made, where it's put in red candles, green candles, and it's overall moved up. But you see, we got to the point here with this low that we made a lower low, and then Netflix came out and beat the Wall Street estimates for earnings. They had a very minimal gap up in which they've fallen from since that time. But I want you to look at something here. We've talked a lot recently about the head and shoulders pattern. The head and shoulders pattern kind of looks like your own head and shoulders. Let's imagine this as looking at a left shoulder, a little hump to the left of your head. And then you got this protrusion that goes up above your shoulders. That's your head. And then you've got many times an equal or close to equal hump on the right side of your head. It's called your right shoulder. The point where we gapped up to after the earnings. Now Netflix has fallen and continued to fall since it posted its earnings. And it completed a head and shoulders pattern. But where is it that a head and shoulders pattern is confirmed? That would be the failure of the neckline, or the dip between the left shoulder and the head, and that dip between the head and the right shoulder. And even though we've had price lows below here, I'm going to draw this line from our lows in January, and we're going to be looking at the close, for which time, if it closes below this line, it will have confirmed a failure of the neckline on our head and shoulders pattern. And if we take this back to the weekly chart, and we look at the head and shoulders there, and you look at the left arm, more than likely sitting in somebody's pocket, if you can imagine it that way, and imagine where the right arm would take us, and we begin to look at the same point on the intensity at which it went up. Now you might say, well, there's no way Netflix will do that. It did it here. And it did it here before the earnings began to decrease. The 126 here from 7/25/2011 was an earnings beat. And it had already began falling. Believe it or not, the 116 posted on 10/24 of 2011 was an earnings beat. And it continued to fall. Then we began the period where it was missing on earnings, but it had already fallen prior to that. And we begin to look at a replication into the exact same chart pattern that was shown back in 2011. And it's not hard to imagine that that can happen because simply it already has. So as we watch for Netflix this week to potentially fail that neckline, we have to begin to focus on the trade for that. That would be more than likely a 4 to 6 month trade if looking at that 205.81 target. But individual shorter term trades catching each up and down bounce while still making lower highs, lower lows along the way are the extremely profitable ones that you need to be looking for. Next, I'm going to move over to Facebook. Facebook beat earnings estimates by 50%. They increased their revenue by 70%. By definition of fundamentals, this was the best quarter Facebook ever had. On the day following the earnings, it gapped up just a little bit, but it didn't even gap up above the high of the day from the day before earnings. And it's done nothing but fall ever since. Now, marking just the bottoms since the gap up in July from their earnings, we are approaching a potential bounce point for Netflix, or for Facebook, I'm sorry. Whereas until it fails that line, you have to assume that it's still just trading within this channel I have marked. But at which time it fails that line, unbeknownst to the fundamental improvements in Facebook, it will identify clear market weakness. One that we've already been seeing. The Nasdaq's been getting blasted at a rate now larger of a pullback than the beginning of 2000 when the tech bubble started. And we're already starting to see that. Now, what's the cause of that? Well, let's look at things like Facebook, trading at 55 times earnings on a price to earnings ratio, where healthy values are considered 10 to 14, maybe 15. So even though they are improving, as the market weakens, the stocks, the big name momentum stocks that have exceeded healthy price to earnings ratios are beginning to see an effect from it. And we're seeing that in Facebook. We're seeing that with Netflix. But there's one that didn't fall. Apple had their earnings this past week. Now, the funny thing about Apple is Apple beat on earnings. But if you look back here at their last quarter, January 27th, they beat the Wall Street estimates for earnings at that time too. That was actually an earnings beat. And they fell like $40. Much like a lot of the stocks we're watching right now that, wow, it beat on earnings and they're falling. Why are they falling? The fundamentals are getting better. Well, see, Apple was already trading at a 14 times price to earnings ratio. The lowest of all the big name technology stocks. But Apple's announced a 7-to-1 forward split. What that means is for every one share that you may be holding of Apple, come June 9th, it will become 7 shares. That's an exciting thing in many stocks. We saw Google do it recently, Under Armour do it, MasterCard do it. It cheapens the overall value of the stock. And what that does is it helps people that, and I don't mean this rudely, but are ignorant to the stock market to think they could actually afford it because it's trading at a cheaper overall price per share. When in reality, nothing changes fundamentally. It just divides all those fundamentals by 7. If Apple was going to make a 10% move as a $572 stock, it will make the same 10% move as an $80 stock. And that's typically how they go. But Apple also increased its dividend and announced a $1 billion per year share buyback plan. All of these things improve the overall fundamentals of Apple, which explains why the other stocks have fallen and Apple's gone up. Thursday afternoon, I was quite impressed with Microsoft's earnings numbers. But Microsoft still failed to close barely even above Thursday's close, the close from prior to the earnings. In the after hours, Microsoft had gone up to a new 52-week high and dropped $2 from it by the time we closed on Friday. Again, a stock that beat the Wall Street analysts' estimates and failed to maintain the price. Another one with the same problem was Zynga. The estimates were for Zynga to take an 11-cent per share loss this quarter. They took a 1-cent per share loss. That is a beat, a huge beat on the earnings estimates. Zynga's revenue nearly doubled. Phenomenal fundamental story. Yet Zynga fell. With no improvements to the share structure, no improvements to a dividend, what is being found in the markets right now is that these excessive price to earnings ratios, the price to earnings ratios that don't make sense, the extreme overvaluing of share prices that simply do not make sense and have been talked about and annotated by experts for a year and a half now, are finally becoming an issue, not because of any individual stock, but because of weaknesses now being seen in your indices. And I wanted to show you these stocks today because for months now, I've put out these market overview videos on a weekly basis and encouraged you to understand how the indices affect your stock. While the indices continue going, big momentum stocks will keep on going because people ignore the things that actually matter to a stock when the momentum is going. But as soon as the indices start to shift to a difference in trend or a weakening of the trend, it is the big momentum stocks that have no fundamental backing to their current share price that begin to fall the hardest. Biotechs, we called the drop on the biotechs a month before it happened. Technology stocks, we've been talking about the drop in technology stocks since the first week of January. Small cap stocks, we've been talking about the point and projected within 0.1%, the first lower high seen on the Russell 2000. We've been monitoring the consolidation period currently on the Dow Jones Industrial Average and the S&P 500 for their weekly charts, as well as monitoring those daily charts and calling with great precision the lower highs and lower lows that are ensuing on those daily charts for the Dow Jones Industrial and the S&P 500. And by using these things to correlate how you trade each individual stock that moves at a rate congruent to its beta rating in relation to the index it trades within, you find a very easy way to trade and a very easy understanding to devise your trade plans for. And even more so, a correlation that saves you money and allows you to continue to profit no matter which way the markets are moving. I encourage you to check out winningstockcoach.com to sign up for my free newsletter, The Practice Squad. I continually offer some different trade advice, educational material, and such for the members of my free newsletter. If you want to come join me in my chat room, see me live, demonstrating charts, speaking on the microphone, explaining trades, and devising plans with my members each and every market day, subscribe to the Coach's Roster newsletter. And let me show you that I can give you the tools, teach you those tools that you need to find financial freedom on Wall Street. This is Coach Mike from winningstockcoach.com, encouraging you to have a plan for every trade you make and to execute based on your plan. Your plan should start with an acknowledgement of the risk of a trade. And your position size should be based on the loss you're willing to take in relation to the percentage risk on that trade. And if you have any difficulties in understanding this, whether you're a member of the coaches roster or not, send me an email, coach@winningstockcoach.com, and I'd love to work with you. Have a blessed day and best of luck in this upcoming week.